Atul, has the picture changed? Good morning. How has the picture changed since we last spoke? Atul, we were, looking at some of those definitive pockets that you were finding interesting in the market, but the overarching picture, given what's happening on the yields and on the global front and with respect to flows, is that something that you've been monitoring closely?
Yes, definitely. It's an area of concern. But what is impressing me is that the way how well behaved the markets are. If you recollect that in a year, we have doubled. The Nifty was around 7,500 about a year ago. We're at 15,000. So you had a 100% move in the index. And it is but natural that markets will pause, will correct. And we have two options. One is that we can have a correction that's down, or we can go into a correction that's sideways. And so far, the market has been exhibiting a sideways kind of correction. So, we are stuck to this 14,500 on the downside and 15,400, about 1,000-point band where we are actually somewhere at the midpoint. So I think that considering the way the US yields have moved, and if you had told me a few months ago that, the yields would be at 160, I think personally heading towards 190 to 2, and would the markets be where they are, I would be surprised. So I think that the markets are showing exemplary strength. If you look at global markets also, you'll see that the US, the Dow continues to make new highs. The mid cap, that's the Russell's 2000, is very impressive. You had a bit of a wobble in NASDAQ, but the NASDAQ has also been spectacular earlier during the year. So the knockdown effect is also happening in global markets. And as far as India goes, that, considering the bond yields, considering the way the dollar has sort of hardened, and we've been able to hold out. And more importantly is that the index definitely shows you a bit of a placid picture. But below that, there is a massive churn that is happening. And there are a lot of stocks that are really whizzing around. A lot of sector rotation is happening. So yes, it's been a bit of a consolidative, or I would say a sideways correction for the moment. But a lot is happening below the bonnet. A lot of sector churn, a lot of move is happening between themes, sectors, mid cap, large cap. So there's a lot of rotation trade that is playing out. I think that is really what's been dominating my mind for the last month or so.
Okay. Another major theme, Atul, has been on the, of course, PSE and PSB front, with all the news and buzz around privatization, which continues. We've been tracking so much of that this morning as well. Do you see this interest continuing?
Yeah, I think that the beaten down stocks or theme actually is the most interesting place, and the public sector undertakings form a part of that. So let's get to some numbers like year to date. That's for the year 21. So we are about 2.5 months there. The Nifty is up around 7.5%. The PSU bank index is up 30%. So that's substantial. And when have PSU banks outperformed the market for the last decade? I don't remember that. Metals is up 18%. You have the PSU space, the PSU basket, or the index itself up 18%. So what you are really seeing is that globally, the beaten down spaces or sectors that have been the worst hit in the COVID fall are actually the biggest gainers. And PSUs form a subset of that basket. So this theme, as I said earlier, is not just in India, it is global. And you will notice that in the 2.5 months that we spoke about, where the Nifty is up 7.5%, the small cap index is up 20%. The mid cap index is up 16%. So the outperformance happening in the beaten down spaces. And as I said, if you go and look at the US, apart from energy as a sector that's done very well, you will notice that the small cap index there also has been the outperformer. So thematically, sectorally, you are seeing that the beaten down spaces are the biggest gainers in the last few months.
Right. Atul, at what point in time you would say that this market is showing strength versus this market is showing signs of melt up and euphoria?
Yeah, so I think that's a very relevant point, Nikunj, because, as I said, we have been around 15,000 playing around. Someday the market's down 100 points and you think that, oh my God, it's, bond yields become the headlines. And someday the markets are up 100 points and, something else takes over. The whole fundamental strength in India becomes a story. But the thing is that we have been range bound. And at what levels would I be worried about is if at the short term, we had hit a recent low around 14,500. I think in the short term, that could create panic for the market. And mind you, there's a lot of retail activity. There is a lot of retail activity in the markets. Globally, really, there's a lot of retail playing around. And I think at around 14,500, that's when the short-term money would get nervous. But I am much longer term in my thought process. And I personally think that we could, or I would only be concerned if the market goes 13,600. Why 13,600? Because this was the pre-budget level. The budget has been quite a game changer for Indian markets, the perception about Indian industry, about Indian markets, or the way ahead. And that bottom was 13,600. So if we go below 13,600, I think that for me would be an area of concern. Till then, I would think this is regular market corrections. As I said, we must remember that we are in the backdrop of a market that's doubled in a year. So, a 5%, 10% correction is good, in fact, because very often it takes away a lot of froth. And why I say a lot of froth is that you can see the kind of data that brokers are putting up in terms of the retail participation. Just to give you an anecdote, I have a school group. A lot of them are in the US, and we've created a WhatsApp group talking stocks. There were about 17 of us who were on the group a few months ago. And most of my friends in the US were very new to the market. They were all talking Teslas, etc. Today, we are around 140 on the group. Because not only are they on the group, their families have got added. And the only thing they talk about is crypto. And even among crypto, it's not about Bitcoins or Ethereum and things like that. There are some unknown exotic stuffs. So what I'm noticing is that anecdotally and the numbers that are coming out, there's a lot of retail in the market. And there is a lot of speculative moves that are happening in very, very high momentum where people are just seeing the screen and seeing movements. So I personally think that if we correct, if we pause, if we have a shakeout, it's actually healthier for the market. And as far as I'm concerned, as I said, 14,500 is where I feel a lot of retail will get nervous. For me, if we go below 13,600, it's something where I would get back to the drawing board, because this level is very important, because this is the low pre-budget. And I think the budget has been a bit of a game changer for the perception and the underlying economy in India.
Atul, let's talk about a pocket where there is a lot of momentum and some catch-up. PSU banks. Well, SBI is the leader there. The real Rip Van Winkle effect. Since we're talking about a school group, I'm using a nursery rhyme example here. A Rip Van Winkle impact is visible in a Canara Bank, in IDBI Bank, in a Union Bank. How long do you think this Rip Van Winkle impact of SBI will continue in other PSU banks?
No, I think it can continue higher, Nikunj. As I said that, this has been a decadal underperformer. PSU banks post 2008, in fact, it's more than a decade now, have been dogs. And they're underowned, underloved, and has all the characteristics of something that was absolutely to be dumped. And what you are seeing is nothing but a pullback rally. I just spoke about that the PSU bank index is up 30% when the Nifty is up 7.5%. So it really shows a lot of froth. But if you even take a recent data point, you take at 2018, which I think was a top for a lot of mid-cap stocks, you'll still find that the PSU bank index is still a fair distance from even 2018 highs. So the fact is that there is a lot of catch-up that is there. As I said, I don't know whether they will be leaders, but this is nothing but oversold rallies. And oversold, what I'm talking about is not 1 day, 2 day, but I'm saying a decadal oversold, a decadal underowned, a decadal underloved, under-researched, forgotten sector. And whenever these things happen, you will always find that the move tends to be sharp. And I feel that they can have a lot more upside, because it's just that if you look at them in the bigger time frame, what has happened is a small blip. And with the markets the way they are, you will realize that the rising tide lifts all boats, and that is happening. And at a fundamental level also, you will find that cyclically things are changing. Will they turn around? Will they not? I think a few quarters will tell us. Is it more sustainable? That a few quarters will tell us. But a lot of money which was never in this space is entering, and that little trickle also creates this kind of effect that there is. So I feel that PSU banks, PSUs itself do have an upside simply because they are forgotten and underowned. And in case things really turn around, then everyone wants to have a foot in that door. And that is something that you are seeing in the market right now.
There are two group of stocks, Atul, and just a coincidence, I'm using groups as a large example. One is Adani group of companies. Every Adani group of company this year has managed to hit out of the park. And second is the Tata group of companies, which in a sense have been hitting out of the park for more than a year now. Now, it's a coincidence, or maybe that's what markets are telling you, how these groups are moving. But every and any stock in some of these groups, whether it's the Adani group or the Tata group, has got re-rated. So if you bet on one each from the Tata group and Adani group, which ones would you bet on?
Well, I don't look at markets as family-owned sectorial thematic bets. I look at them more as sectors. Yes, it's a coincidence that sometimes some family does well and other well. So if you ask me in the Tata group also, I look at, whether it's a Titan or a Tata Chem or a Telco or a Tisco as companies that are independent and sectorial and thematic. So I really would not bet on a family per se, just because one stock is moving. One has to look at the fundamentals of each of the companies and what is really changing there. So I would not take a family approach towards investing. I would keep myself more towards the market, the sector, the theme that is playing out. And in that, if they find a mention, which they would because of the momentum that they have, I would be happy to grab it. So my framework or my matrix of looking at companies is not family oriented, but more sectorial and thematic, because I feel that ultimately it is what is really happening at the sector level, how the companies are able to benefit is ultimately going to really be the way how numbers are going to come, how the stocks are going to perform in the long run. So I would look at things a little more different.
Atul, hi there, good morning. So let's talk sectors then, and perhaps zero in on the real estate space where you believe that there was a lot of government focus. How have you read into steps that have been taken, and do you think that there is still a strong potential within the real estate space? Any preferences that you'd like to highlight?
Yes, again, it's very much with the thesis I've been talking about of the whole beaten down space. You had metals, you had PSU banks, and you had real estate, decadal underperformers. And here also you are seeing that spike. As I said, the initial stage always tends to be euphoric or sharp because they are underowned. However, whenever there is a cyclical change that happens, whether it's your industrial cycle that's changing or the fundamentals, or a decadal change that is happening, you'll realize that these sectors, stocks will attract that kind of money because just very few of us have that in our portfolio. So I think that as and when the fundamentals of that sector will improve, whenever you find companies that are reporting good numbers or improvements or commentary or whatever there is, you will find flows. But in the real estate sector, the only thing is that people have been burned very badly in the past when they've got into companies with little bit of questionable managements. So I feel that the move in real estate is going to be more concentrated. It is going to be linked to the few names which have proven themselves credibly through the downturn, and where there people feel that there is certain amount of corporate governance that there is. So again, a sector which sticks to the theme of the beaten down space is doing very well. But here also, I would stick to good quality managements and names, because we all know at the ground reality that this sector has its hits and misses. You've got issues of corporate governance, execution, etc. So I feel that some of these stocks can definitely be very, very big movers. Another way of playing this sector, if you don't want to get into the developers, is actually go through housing finance companies, because they also would be a big beneficiary if the whole sector turns around. So thematically, you can extend it and play a kind of a hybrid between an NBFC and housing finance, which would get you a proxy into the real estate sector. Because in that space, there are a lot of companies with very good managements and proven track records.
And does the thesis when it comes to the entire consumption space get a bit challenged when it comes to the, the rise in what we're talking about as these agri-inflation, as well as the uptick that we've seen in fuel inflation? How do you believe one should be playing the sector in light of these concerns?
Absolutely. In the short term, that's been a challenge, and that is why the year-to-date performance, you'll find that just as PSU banks and metals and all are at the top of the pyramid, you'll find that a lot of these consumption-related sectors are at the bottom of the pyramid. And in the short run, yes, there is likely to be an impact of inflation. If you think that crude at $70 globally is not going to impact, I have my doubts. It is going to have a knockdown impact. And you are going to have challenges in the short run. The other thing is that this was a sector that didn't do too bad last when the COVID fall happened. In fact, it held out, and a lot of stocks were actually the best performer. So you don't even again have that issue of under ownership or unloved. All funds, all investors are pretty heavily, invested in this space. So you don't even have that kind of flow. However, if I look at the longer term theme, which is beyond just a quarter or a few months, I feel that consumption is a very, very big secular trend in India. The only problem with consumption is that it tests you. Stocks in consumption basket don't really fall off, but they go sideways for months and sometimes even years. And that is when you get tested for patience. So when consumption stocks are doing well, you look back and said, I wish I'd held this for 10 years. It would have been such a great compounder. But I have seen that the journey of 10 years is not every year is equal. You will have phases where you will get tested. These stocks, as I said, do not really crap out, but they tend to go sideways. And you feel really left out because the rest of the market is doing so well. And here, you find that you are underperforming even the index. So on a longer term, a longer theme, I think that this is one of the most secular trends in India and one of the best places to be invested in. But unfortunately, in the short run, yes, they have some headwinds and they are moving sideways or relatively underperforming the index. So one has to really, see from what mindset or what approach one has towards investing. For a long-term player, for a long-term investor, this definitely is something which has to be a major part of your portfolio. But in the short run, yes, there are headwinds, and yes, they have, underperformed the market in the last few months.
Okay. Atul, anything that you're cautious on? What about some of the, names that are more vulnerable to what's happening in global markets, or even though, and they've also been outperformers? What does one do with, for instance, some of the IT heavyweights right now? I mean, given where they're trading, given, of course, there's nothing wrong fundamentally speaking, but what would be the strategy?
Yeah, that's again a very relevant question, and that's very central, because one cannot get away for very long from what's happening on the global macros. Because, if you look at FI flows, we know from our point of view that they are the primary drivers of the market. And you'll notice that for a month or so, let's say the last 15 days for the month of March, I mean, it has been a placid month. And if you look, you don't have to look far, you'll realize that FI flows have been very, very tepid. I mean, we've had, I think, something like 2,500 crores that's come in, which is a very, very small number. This is the kind of number you would see on a single day a few months back. So FI flows, which do determine the momentum in the index, in the markets, have been under check. And you cannot ignore the fact that they are affected by global macros, whether it's your bond yields or whether it's your, the way the dollar is moving. So as I said, that coming to the question of bond yields, I get around 1.6 something. I personally think that US 10-year bond yields will get to around 1.9 to 2. And it's not that all is lost. As long as it's orderly and slow and crawls up, I don't think it's going to create much tremors. However, the key thing is that the US dollar, the DXY index, should not be spiky. So in spite of bond yields going up, you'll find that the dollar index has been okay, has been under control. It's not coming off, but it's not been spiky like bond yields. So I, for one, would really look at that. And this really will determine flows, because a lot of ETFs are very, very linked to these. A small change here actually creates a flutter there. And FII flows are very important for Indian markets. So I, for one, if there's anything that I watch in the market every morning, apart, of course, is how the US has closed, is immediately how bond yields have done and how the dollar has done. Because that, I feel, is really what's going to impact Indian markets, which are so dependent on FII flows. So I feel that bond yields would head higher. As long as it's orderly and not spiky, I don't think it's going to create much crisis. At best, they could help us with a nice sideways correction, which would be a dream situation, and this is what we are experiencing right now. But in case the dollar takes off, that's when I feel that we may have a little bit of a short-term problem. Overall, very bullish on the market. But yes, there are short-term headwinds, and they ought to be there. They have to be there. As I said, after having doubled or after going up 100% in a year, markets have to have a reality check, and that's what's really happening.
Okay. Atul, the all rotation buzz which we've seen, it started with chemicals, it started with pharma. Is the multi-year bull run getting challenged? Because if the narrative is growth is taking a backseat, value is making a comeback, that's applicable in the way how S&P is doing better than NASDAQ, how PSUs are doing better than pharma, how corporate banks are doing better than retail banks. Is that whole multi-year bull market theory in chemical and pharma over?
I don't think so. I definitely not think so. I feel that this is an opportunity to get into these stocks in this correction, because as I said that when we had the fall in the market in the COVID phase, you'll find that a lot of companies, a lot of sectors were priced in for bankruptcy, and the sectors that are moving right now were the ones that were absolutely beaten blue. So you will realize that when the reality comes out that, we've forgotten what the sentiment was last year in April, May, June. One was questioning how much of the human race would survive. The kind of extrapolation that you had, sectors, themes, everything would change forever, etc. And now, obviously, we seem to have forgotten that. So the sell-off that happened in these beaten down spaces was so dramatic. So the market is realizing, thanks to healthcare, helps to the vaccine, that okay, we are not going bust. And what you realize is that very, very cheap valuations that emerged and an opportunity that pulled markets up. However, the pull-up will come to a point, but beyond that, it is all about earnings. And it is about delivery. So the low base effect or cheap valuations will have an impact till a point in time. At some point in time, these also companies will get fairly valued. And then you are going to ask yourself that where is the growth coming from? So ultimately, there is no getting away from growth. There's no getting away from earnings. And that is how markets will reward stocks. They will reward sectors. You may have phases. And in this phase, what I think is that companies and sectors that were priced in for bust is not happening. People realize that, yes, we are getting back. The world is getting back thanks to great research, healthcare, a lot of stimulus. You cannot take away or give credit to the Fed Reserve for where we are right now. And you will see that these prices or this thing that are really settled low will come up. But beyond that, Nikunj, I think, or my understanding is, because I am a growth investor, ultimately it is earnings, earnings, and earnings. Wherever there are earnings, the market will reward that with a bit of lag, maybe. So the sectors that you mentioned continue to exhibit excellent earnings. It is just that at some other place, things look very cheap and market is using that as an opportunity. But there is no getting away from earnings, earnings, and earnings.